All right. Hey, gang. So I am happy to be back here. This week we're going to be talking about 3 signs of trend exhaustion. And since we got a couple of minutes here before our normal start time, I'll tell you guys a little bit about myself. I started trading in the mid 1990s. This was just as online trading kind of kicked off. There wasn't a lot out there as far as education went for technical analysis. A lot of people were just really trying to transition from floor trading to online trading. I started out as a swing trader. So in stocks, focusing on multi-day moves. I consider myself to be pretty much a self-taught trader because I spent thousands and thousands of hours just watching the markets day in and day out and actively trying to analyze them, looking for patterns and systems within the market. But at the time, the most complex system that people were teaching was, hey, buy like a 5 to 7 bar pullback into a 20-day moving average. It wasn't terribly useful because you could find as many instances where it didn't work as well as times that it did work. So I started breaking down the patterns in the market. So things like our bull flags and bear flags, looking at specific traits that were happening within that congestion to give me a sign for, hey, when can I actually buy this? When should I be getting out of it? You saw a little bit of that in some of the previous presentations here where you're talking about like ABCD type of patterns. That's another one of those things that it's been around for a long time. But again, you've got to get into more of the details of what's going on within those actual formations. Otherwise, you can find as many examples of it failing as you do examples of it working out. So in today's session, we're going to talk about the 3 specific signs of trend exhaustion that I look at and how these can help you really kind of narrow down what those pros and cons are with regards to timing. Is this something you want to take? Is this something you don't want to take? I'll show you some examples from over the years as well as from today and this week. In fact, if we have time, I'll even pull up the charts that we've got right now. I just had a target level hit on a trade I was in the Dow. So if we have time, we'll go and take a look at that as well. All right, you guys. So my charts today are primarily from NinjaTrader. And here's your standard disclaimer. Of course, don't bet the farm when you're trading. Let's move on here. So how do we recognize trend exhaustion? So first of all, let's start with the basics. What is a trend? So when we're talking about a trend, we're talking about like the primary directional bias that the market is trading in. And you'll see a lot of templates for a trend. The most standard template you're going to see is one that goes like this. Here, 3 waves up, you'll get like a zone of congestion and then, 3 waves down, and you might see, 2-wave trend corrections in here. I have a little bit of a different template up here that I drew for you guys. And you'll notice that as we go and discuss the market action here, even today, if you keep this template in your mind, we're going to see this playing out over and over again, almost this exact formation here, where we have the really strong impulse move. We've got 3 kind of smaller moves on the upside here, shifting momentum, stronger movement down, another zone of congestion, and then a stronger breakdown. So you're going to see this exact formation in a trend playing out over and over and over again. So trend is, again, in an uptrend, you've got a series of higher highs and higher lows. So our higher highs, our higher lows. Downtrend, you've got lower highs, and then you've also got our lower lows forming. So that's just a very kind of straightforward, simple definition of what a trend is. So when we're looking at a trend and we're looking at the type of action we want to see in a trend, one of the first things we need to know is what an impulse move is. So an impulse move, you guys, is just the major momentum movement that is taking place in a trend. So each of these stronger moves here, these are what we would call our impulse waves. So keep that in mind as we go forward. Again, here you've got your series of higher highs, higher lows. Then we've got lower highs and lower lows. So here we've got our uptrend and then the downtrend. So again, very simple definition, but we're going to get into more of the details of how do we know when this uptrend is actually going to end, and how do we know when this downtrend is actually going to end and give us a reversal. So let's flip this on over here. Kind of got ahead of myself, didn't I? Our impulse moves are fractal in nature, you guys. So what that means is that you're going to get the smaller impulse waves within the context of the larger ones as well. So that's just what that means here. So what are our 3 signs of trend exhaustion? Well, first of all, we're going to look at measured impulse moves. So when I'm first examining a pattern to see if it's something that I want to trade, I need to know where I'm at in that larger trend. So this is just a pretty small time frame chart here. This is actually one from a couple of years ago. We're going to look at very similar action here today as well. And one of the signs of trend exhaustion is to identify that initial impulse move and then look for levels where we have very similar impulse moves, the same size. And as that comes into a support level, that gives us a really good idea that, hey, we're not going to want to jump on board for really strong short patterns if we have a couple of impulse moves in a row. Now, those impulse moves are fractal in nature. That means we can get a bigger impulse move that can have a couple of the smaller ones in it as well. And the larger they are, and the fewer examples you have of anything that's even bigger than the ones you're looking at, the more likely you are that you're at a major trend exhaustion. So here, the 2 small waves are pretty common. We see those over and over and over again, even on like the corrective moves. They're very, very common. So just getting a smaller impulse move isn't going to necessarily end the trend. It can lead to a zone of congestion or correction that can be short term, but it won't necessarily end the trend and lead to a longer correction or trend reversal. But if you have examples of the even larger moves, where you've got those bigger impulse moves, you've got a better chance that that's going to go into a longer correction and have a much more difficult time maintaining that trend. So that's just the first term that you need to be familiar with, are those measured impulse moves. And then here's an example from today. This is our NASDAQ from today. This is the 800 tick. This is actually the micro. So again, you can see those smaller impulse moves are very, very common. They happen over and over and over again. Then we start to get some of the bigger ones and a lot of repetition for those as well. So this morning, for example, we had a nice move into some congestion over here on the downside. And what you're going to notice about these impulse moves is the momentum. So in order to accurately gauge that that impulse move is at a zone where it's going to have a harder time continuing, you want to make sure that you're comparing previous impulse moves that have similar momentum. So if the momentum is a little bit slower or a little bit faster, you could have that go a bit further or a bit shorter than your comparable moves. So here you can see, it's coming right into a support level where you had a lot of impulse moves come together. Now, another way you can do this to judge if this is a good support level is you can physically go and add your line on your chart, grab that line and move it over, hook the top up here, and then that's going to give you an idea of where the bottom is. So if you hooked up the top there, it would give you a bottom, right about here, which if we flip it over would be right about here. So you could take each one of those, draw the line, move it over, and make that comparison. And if you have a whole bunch of them all lining up at that same spot, that is a pretty good level to tell you, hey, I need to be protecting my gains on this and even possibly starting to look for reversal patterns. So here is how this ended up playing out. We had some of those smaller moves here, and here was the pullback there, bounced, came back up, had again that same measured move on the upside. Here's an example showing you how what I did was I took the line that I drew here and I just moved it on over here, starting at this high and looking at those measured impulse moves. So that gives me a good idea. Wow, there's a whole bunch of them all coming together here, right at that same location. That means that's a pretty good zone to protect some of my trade, if not all of the trade. So the second thing we want to look at is our wave counting. So this is an older example from Netflix that just shows you an intraday chart. And a lot of you are probably familiar with, counting waves in terms of threes. So we'll have an initial move, a secondary move, and then a third move. Now, when you're counting waves like this, one of the things that's really important to pay attention to that most traders don't is the time development between each of those waves. So what you want to look for is, in order to get accurate wave count, you want your correction periods to be about the same between those waves. So trends often come in waves of three. I'm going to show you something a little bit different here in a second, but they often come in waves of three, where if they then try to put in a correction that's that same amount of time, so let's call this A, this is B, let's say C tries to correct for the same amount of time, but we already have one move down, two moves down, and three moves down. Well, this as a short continuation is high risk. There are going to be situations where it can try to do it. You can see here, this is the same amount of time, but getting a move going that has the same momentum as the stronger impulse moves in here is going to be very, very difficult. A lot of times, even if it starts out very quickly, it can get stunted. So it might be half of what your previous impulse moves on the downside are. There again will be exceptions, but they are pretty rare. The main thing that tends to happen is that when it tries to do another move, it will shift momentum. And so it won't be able to follow through as quickly as the previous moves are. So be very, very cautious if you have three impulse moves down, same momentum, and same time per period for the correction. That's going to exhaust the trend. So that means here, we wouldn't want to short that where we get the same amount of time, because the reward compared to the risk just isn't going to be as good. Or if you do go ahead and short it, knowing that it might go into, a base instead, you would need to use more advanced trade management, be more aggressive on managing the position and be aware that there's many cases you're going to end up getting scratched. So here's another example. This is from this morning, and this one is in our Russell. So we have that first impulse leg here, and we actually have 3 smaller ones within that bigger impulse move. We have our second wave here, and then our third wave here. So look at the correction period though. See how those are the same amount of time? So that's allowing us to get a decent third wave on the upside. So at that point, when we get the same correction that's the same amount of time again, look at that bounce there. It can't get going and to create that solid fourth wave. So when you see this happening, there's going to be situations where you can take that correction period, double it, and then you can get a fourth wave. But that fourth wave will typically be the same size as the previous 3, and then it will end the correction and break the trend channel. Now, it can go out much longer. It can take the entire upside move here and do a time development where it's the same amount of time, essentially quadrupling the distance here. So taking this and then going twice there, that can go at that point again, but it will generally have broken that uptrend channel. So you'll get a series of the lower highs and your lower lows coming in. So it will technically break that smaller trend channel there. Now, here's an example from a little bit further back. This again is back in 2020, but I'm going to show you how this played out the exact same way here today. So what you see here is we've got kind of a double top here. So I wouldn't count this as wave 1 on our downside move. I would count this as wave 1. Here's our correction, wave 2, correction again, wave 3, and then this leads to reversal patterns. Now you can see I've also got Fibonacci retracement levels here. And this is our, let's see, this is our 23.6, 38.2, 50%, 61.8, 76.4, and this is a full 100% retracement. So it's also coming back into a zone where we had previous lows. So we have that support level there as well. So in this, you can see I took a short, took it off at the measured move as well as that previous low zone, and then I flipped it. Now, the thing with flipping it like this is that with the momentum, it could again have that slower move. It might go and do that same amount of time correction, try to break down for a fourth time, but shift. So you really have to watch if you're taking a pivot at that point. Look for something that has a smaller time frame setup. Don't just take it because you're at the end of wave 3 and you've got a measured impulse move. You have to have another reason for that. It just tells me that, hey, this is a good location to begin to look for potential corrective moves that can be larger than the previous ones. So here is this morning on our NASDAQ. And what you'll see is very similar type of trend development. So wave 1, wave 2, wave 3. So you have it looking like this. Basically your 2 corrective moves and then your 2 main moves on each side and then another move here in the middle. So again, this is, a good zone to be looking at for trend exhaustion. Now, here's something where I changed the way that I count, where I don't normally count in waves of 3 as my predominant trend moves. I tend to focus more on waves of 2. And what this means is it still brings in the waves of 3, but it's the way that I look at it is a little bit different. So if we look at that 3-wave trend move here, for example, what you'll notice is that in this case, that second wave is a little bit shorter than the first. And then we've got that bigger third move. So normally how I count waves is I count in waves of 2. So I would count this as wave 1, this as the 2-wave correction, and then this as wave 2. Now, what that does is it's going to give me the most likely zone of where I can see a bigger stall. So for example, here we've got one main move, a correction zone, and a second move down. We can look at this as one wave move, a correction zone, and a second move down. And we can also look at this as one move down. This is our correction zone because it's breaking that trend channel. And then this is the second move down. So if I think of things like this, it's much easier to get a normal trend exhaustion move. So trying for this to go for a third move, yes, it can happen, but it could also treat this as two waves, go into a longer two-wave correction, and then go down. So it kind of prepares me for that potential for a longer correction. One of the ways that we can look at our trends in waves of 2 versus waves of 3, I mean, first of all, they're much more predominant. We are much more likely to see a 2-wave move in a trend than we will to see a 3-wave move in a trend. So what we want to look at in terms of counting the waves of 3 is that we'll often see it go like this, our waves of 3 down, and then we'll get our correction from the trend. Other ways that this can form, though, is that it can have one wave down, go into a 2-wave correction, have a second move down, and then that ends that smaller trend move. And basically, this first correction here is going to be comparable in terms of the time development as the first wave here. We add the two corrections in here together, and you get that same zone for the correction in here. So the ways the momentum can play out, you can get one leg, a shorter leg, a third leg. You can get it going like this. We could get it going like that, where it has the full bigger trend moves. So it's just treating this kind of midway zone here as the corrective phase instead of just counting this as another leg that's on its own. So this is something that's a little bit different of how I've shifted trends over the years to focus on them, because that allows me to think of these two waves of correction in the middle as places where the momentum can shift overall. Now let's go and take a look at another example here. So here, again, often thinking in terms of two legs. So if you get that third, a lot of times that momentum can be shifting. Or here again, you've got your two waves down. Here's the correction that's the same amount of time. It doesn't get that third one going. But if it did, it could have risked going and just shifting like that, like you see up here, and not really giving you a solid third move. So if you count in waves of 2, that can help you in terms of your market timing a little bit better. Now, the third thing that I look at is momentum shifts. So we saw on Netflix, for example, the really strong impulse move on the downside this on that chart. It was a 100-tick chart, really strong. So there's barely any overlap from bar to bar. We get like the large Morobozu type candlesticks in the middle, just a really solid, stronger than average move. Then notice the momentum of that second move. It starts to shift. We get a slower move for that second move. This is a way that we often see bear markets come to an end. We see that slow shifting in momentum where we get the really rapid drop to begin with, slower secondary drop, and then an even slower third move. And a lot of times each of these waves is going to have 2 or 3 predominant waves on the downside as well. So you can get, here we've got 3 in that first one. I can't really tell on the second one. You've got 2 in the third one here. So that can help you with like that smaller trend exhaustion there. Just paying attention to, hey, our leg counting on our larger time frames has 3 legs down. If I go down to the smaller time frames and I also see 2 or 3 legs down, that can help me with the reversals. Now, when a trend move is happening like this, where we get that shift in momentum, we can get a break in the trend channel, but it doesn't necessarily fully turn that trend around. What you need to see is a bigger reversal pattern. So for example, here, this is a shallow phoenix. So that triggers a buy here, but then we get momentum shifting again right here, allowing it to pull back. So you essentially have 1 wave, 2 waves, and then the correction again. But if you have the 3 legs where it's moved down, you're typically only going to be looking at one more flush and then having it try to bounce again. So at this point, I'll look for reversal patterns, but the strongest ones will kind of break this trend channel, pull up, a lot of times give us a little bit of a flush, and then reverse. So I like to see this flush oftentimes having 2 waves in it, taking out this previous low, because it takes out all of the stops. So when I'm entering a position with a trend exhaustion here with my wave count, I might go and do like a smaller trade and look to build into the position, knowing that I could get that flush happening. So this is a very common manifestation of how trend exhaustion moves happen. So you'll see this on anything that follows human behavior. You'll even see that on like the COVID charts. If you go and look at COVID infections over the last couple of years, you'll see that same pattern playing out. And even when we had COVID spiking, I pulled up our stocks that had our exhaustion to show you what those bottoming patterns look like. Here's another example. This one is on our NQ here. So again, really extreme momentum move, correction, secondary move, correction, 2 waves in here, 2 waves in here, tries to go for third, but again, overall momentum is shifting. So it has a hard time doing that. The initial bounce can give you a starting trade, but there's a better chance that it could flush it before it gives you a better reversal. Now, if this totally takes out the previous lows here on that flush, that tends to be a better reversal where you're going to get momentum picking up more strongly on the upside. So you would see a nicer reversal pattern. If it's a security where you are dealing with it like going out of business, or things like Blockbuster back in the day, or any other, we've seen Weight Watchers do this type of thing a couple of times, where it will go parabolic, but then people will realize, hey, you know what, this security really isn't worth much. They might be like a one-trick pony. And so what you'll see is this will be like an initial first wave. You'll get the correction, and then you can get things kind of shifting further on the downside, where this will be wave 1, you'll get wave 2, and you'll get wave 3. And it'll kind of just keep shifting the momentum in those increments like that. So it'll look like, for example, here, this will have, that smaller shift in it, but after it does a correction, usually, like 2 waves again, it'll come down again. Not necessarily the same momentum as the first time, but shifting the second time. You might get an even better bounce this time around, but then shifting again. So you'll see those consecutive lows again with the smaller trends, but the overall momentum of those trends shifting. And then maybe news will come in and people will bring your pump and dumps in, and then it will fall back down under like $10 a share and kind of, fluctuate in there. So you'll see that happening over and over again. Here's another example with momentum shifts. So that's not the only way that we look at momentum shifts. For example, we can look at a slower shift to begin with, a more rapid midway secondary move, and then a slower third move. So other ways the momentum can form is we can get a slower starting move, faster secondary move, and then a really steep third move. This is when things go parabolic. We see that a lot more on the upside, but on the downside, it's a little bit more predictable in terms of, hey, where's that parabolic move going to end? On the upside, this parabolic move can actually put in a little pause and double, so you get a bigger two-wave move. But on the downside, this becomes a good zone to then, look for smaller reversal patterns and shifts in momentum at the support. My favorite though for timing reversals is when the market is stronger, slower, and then the slowest, because that can lead to surge moves a lot more easily. Can we anticipate what the ES is going to do this afternoon? Absolutely. We'll go take a look at that here in a few minutes. So here's another example where you're looking at your three-wave trend move here, 1, 2, 3, the exhaustion, two-wave correction, two-wave move up, two-wave move down, shift in momentum here, triggers the buy. Now, typically on a buy setup like this, I would have my target level as at a measured move. It would be up here. But if I had this coming in and then going into a correction that lasts longer than the moves on the original impulse move over there, that tells me I might need to get more aggressive in my trade management, that it's starting to shift momentum, because even if I connect just this low here and this low here, that's changed the overall momentum compared to that initial move. So that means, hey, watch for smaller trend exhaustion moves. So like the smaller two-wave up here, the momentum shift here. And that can get me out of the positions close to the highs, but not necessarily at that original target that I was aiming for. Now, those highs can also allow us to identify reversal patterns when we have shifts in momentum like that. So here, this is a chart again, you're back in like 2020, and we can see our kind of an initial movement, stronger, shallow, and we get this momentum shift with the three lows coming into play. So here you can see the bigger two-wave correction. So we've got that nice two-wave correction into support from the lower end of this congestion, and then we get the momentum shift coming into play. That is a beautiful buy pattern when you see that happening. I call it a momentum reversal. Ideally, what you want to see are V's and inverse V's in here. You want this to have the trend exhaustion. So over here, you've got the nice two-wave movement and then the momentum shift. So by shifting that momentum at the end of that second wave, it allows for a stronger reversal to happen. So if we look at, here's a recent chart in the market, and we can actually see this in the Dow, and I'll pull up the Dow in a second. But here is a recent one. This is from one of my traders. They posted where they had, again, kind of those two main impulse moves. You get your three-wave trend here. And then we get the V's and the inverse V's. And that triggered the reversal for this. We saw this yesterday too, intraday. Right around midday, we had the same type of reversal happening. You can see it on pretty much all of the indices. So that triggers our reversal. Now, what you'll notice here is they have also got some fib. They've also got some fib fans here coming into play. So if you miss the original reversal, if you connect your high to your low here, that gives you a 76.4% Fibonacci fan. And that's a good zone to look for as a continuation zone where you can get that second move of selling coming in. So here is our euro dollar this morning. So you can see the same thing happening. The stronger move here, our two-wave movement, shorter secondary move, shorter third move, again, two-wave correction in here. But the overall market action is shifting here. So what's nice about this shift here is that we then have not only a smaller trend exhaustion with the two-wave, but we also have that V shift with the movement at the highs. So you've got your three main highs happening after, this is what I call a leg. I call this a kneecap. So we've got that overall shift in momentum here. And then we've got the smaller shift in momentum with our three highs. That is a very, very strong reversal pattern. So in the euro dollar, you can see the really nice two-way pullback here happening. The main support level that I typically will look for in a pattern like this is to use where that momentum first begins to shift. That's usually what I use as a main target zone. That actually helps me nail the lows in the NASDAQ last night too. It was the same zone for the support that led to our new trend this morning. Let me see here. Here's our NASDAQ chart. So that reversal overnight was right here. So what I was watching yesterday was our two-wave movement here. And then I was also looking at this as a two-wave movement, but what you'll notice here is this is a lot stronger. So the momentum actually began to shift here. It was coming into a support level over here. This is the three highs that I was talking about for that reversal yesterday afternoon. Here was the comparable reversal over here. Again, our three highs with the shift in momentum. So this was the one that triggered the afternoon reversal yesterday. And then this is the one that triggered that continuation yesterday. So as this popped up here, you can see that the momentum began to shift right here. So we had that strong impulse move and then the shift in momentum. So when that came into that support level again overnight, I began to look for reversal patterns. And that's what helps me catch that reversal there. So you can see, again, same type of thing happening up here. Here's our shifting in the momentum. We don't have the three evenly spaced highs though. We have kind of a shallower move here in the middle, which means that it can have a harder time bringing in a stronger full-on reversal pattern. So I like to see those waves where you get the V's and the inverse V's. That's going to be a stronger reversal pattern. Like I said, we can even see this on our COVID charts, you guys. So if you look at your wave counting here, on the upside, we only have two waves that are about the same momentum. So I call this the leg. This is our leg. And this is the kneecap here in the middle. And then here's your three highs. This is actually one of my favorite reversal patterns because after that third high, it comes back up and does a double tap. So what it does is it looks like this. It comes up like this. It has the three highs, shifting momentum, and then it has that double tap. And preferably, it will come into this lower end of the channel. And on this bounce back up, it won't make it back to the upper end of the channel. So this is one of my favorite reversal patterns. Your time development is evenly spaced between these three highs. So it's not quite a head and shoulders. If you're looking at this as the shoulder and this is the head, that would have a bigger shoulder over here. So if this doesn't get going there, it could do a secondary correction before it then goes, so that you have that even spacing for the bigger head and shoulders. And then here we've got our nice 3 legs down, pretty comparable momentum in there, and then the shift. So this is showing our trend exhaustion here. Now, in a market where things are kind of, dying out, then what you would have is often a little bit of a channel break here. And then this would shift momentum again. So you would have this as your first move, second move, and then it would continue to come in here. And you'll get occasional spikes that will happen. But if your security is basically going to be delisted here pretty soon, then you would have this, continue to shift into levels like that. So these zones where you get, these smaller 2-wave of corrections or 3 waves, you can get those little spikes happening. And that will often be like what we would call like a pump and dump in a penny stock. You'll see that happening in those. In a security that is much stronger, and this level's not, like down into the teens already. So let's say this is pulling into like $300 a share. Then you can get better reversal patterns happening at those levels where that can actually go and take off again. So this could be, a big major uptrend, and this might just like be a smaller minor pullback that's happening intraday. But it's that same idea. All right, you guys. So I hope you learned a lot in today's session as we talk about trend exhaustion. We get a chance here. I'm going to pull up our market so we can look at this, as it's playing out right now. But first, I want to tell you about a course that I have. This is an extremely extensive course, and it pulls in Fibonacci tools for helping identify trend development and trend exhaustion. So Fibonacci tools help you with timing, your market timing, not only looking at, hey, has this correction lasted long enough, but is it at a good enough support zone? And the course also pulls in specific strategies that I trade and goes into all of the details on those strategies. So big focus not only upon just trend exhaustion, but also what patterns can we trade when we get that exhaustion happening. So it's a 4-week course and it's all available on demand. The first week talks about my tools of the trade. So it talks about things like the time development. The second week talks about trading the trend change. So we're looking at reversal patterns. So things that we can trade, like that momentum shift with those 3 highs and those 3 lows that I showed you, how to trade those specific patterns, what to look for target levels, how to set our stops, and how to adjust those stops so that we can get to break even on a trade that ultimately fails. So instead of taking full stop levels, you can take break even or pretty darn close to break even on the trade. The third week focuses upon riding the trend. How do we know that we're going to get 3 waves of a trend move? How do we know that the trend is going to have a stronger momentum move, and how to get into that trend? So we're focusing upon strategies for continuation of the trend so that you're not getting in too early and getting a false start and getting flushed out, and you're not getting in too late where it traps you and then reverses on you. And then week 4, we look at those absolute pivot levels. So patterns for nailing the absolute highs and lows. And this is something folks that follow me daily will see me do often intraday. And it's because it's a combination of all of those first 3 weeks of analysis and tools and systems that I use. So that is going to help with timing those absolute highs and lows, and then being able to build positions for the second and third week strategies. So right now you guys can pick up the full 4 weeks for $149. It is a lot of data. I think it's something like between 10 to 14 hours of class time. So what you learned here in just like 45 minutes, I actually cover that in substantially greater detail. So you'll have access to my forum where I post charts. You can ask questions anytime. You have assistance from other traders that are showing you their examples of them. You've got lifetime access to the course, so you can go back and review it any single time you guys want to. So take advantage of that by going to that ToniHansen.com/fibsrock, and you can access that as soon as you register. All right, you guys want to take a look at our current market fast. Got just a couple of minutes, so I'll try to get this pulled up really, really quickly. Gotta find my charts. Let's see here. They're hiding back in here. Here's our ES. So here's the S&P 500 you guys asked about. So here you can see on our 60-minute time frame, we had that 2 waves of trend exhaustion, and then we also had the 3 highs up here. So this helped us look for reversal strategies over the course of the last week or so, focusing primarily on the downside move. So what you get here is that in order to get that third leg of downside, we would have wanted to have similar correction here to here to lead to a third leg of downside. So what this tells us is that our first 2 waves are our main moves, and this can actually go out and double at this point before it could have another chance. AE asked, is it an online course that you can follow at your own pace? Absolutely. Yes. Even when I do live courses, I always record them so that you can go back and you can study them at your own pace. Let's look at this on our intraday here for this afternoon. You can also see 3 waves up on that. So that gave us, some trend exhaustion here this morning. Right where we are now. It's also at previous support right in here. So this is actually a really good zone. If you look at impulse wave size, this impulse wave, and then comparing it to some of the other waves that have the same momentum, notice that we're pretty close to that limit. So what that would mean for me is that going into the afternoon, I wouldn't be very aggressive on the upside. I would be looking for reversal patterns, the potential that this could go into longer congestion here, just because it is a pretty average impulse move. So you can see how long some of those periods of congestion can last. So here's about, same idea. So it can go into a pretty long zone of congestion or correction at this level. We often call this a zone of pain because the pattern that plays out following an impulse move can develop in many numbers of ways, and you just have to look at that smaller momentum shift to identify which smaller pattern. If we get a zone of congestion that lasts, about that same amount of time as some of these previous ones here, and it goes into a longer base like that, well, that can give us a good secondary move on the upside. All right, you guys, David, thank you for having me here. And I hope you guys learned a lot. I do offer online classes every single day where we follow the market every day. You'll get information on that by signing up for the Fibonacci course on demand as well.